Good morning. Crazy morning. Uh, Good start to the quarter, everybody. Great start to the year. Thank you so much for tuning into this. This is being recorded, so for those of you who have to jump off, feel free to do that because you'll be able to get a link. And I can go a little long, but there's a lot to talk about. There's a lot to review. And we're just really appreciative of the fact that one, you trust us in this capacity, but two, that you're taking the time here this morning to jump in here with us. And I didn't plan on this happening on a day. We're going to blame Eric Oshaki for scheduling the webinar today on post-Liberation Day. So I think we were all liberated from a little bit of necessary sleep, maybe liberated from some 401k values yesterday, some stock values. But without further ado, I do want to share some images with you, and we'll run through this, and then we're going to have some good time for Q&A as well at the end of this. So bear with me as we fly through a lot of information, and I'm going to talk all about, sort of key fundamentals here and some things that we're going to see, not only with some retrospection, but then we'll talk about what we see coming down the pike, and then the questions at the end are the most valuable part. So I would encourage you to hang in there so that you can get your questions answered. And to start, I'm going to talk about the fundamentals for gold. We obviously are your precious metals advisory firm, and Eric and Deanna and I are your team to help you in that regard. But we have to be looking at macro. In order to advise you, we have to be looking at what's going on economically, monetarily, fiscally. We'll get into some of that, and then obviously we'll get into the dynamics of the market. But why are the metals doing what they've been doing over the last year, and certainly to start this year? I don't think I have to state this morning as a perfect example of uncertainty in the economy. Fiscal irresponsibility is something that we're going to continue to absorb, decades of fiscal irresponsibility, which is part of why we're witnessing what we're witnessing today. Loose monetary policy, geopolitical tensions, and fear and greed. So if you just take those five primary fundamentals, you'll realize, okay, well, no wonder the metals are doing what they're doing. It's been a lot of conversations, a lot of hand holding, a lot of advising and educating, and I hope that that's what this is. And ultimately, the takeaway here at the bottom, all roads lead to gold. In all of those categories over our lifetime, that's been the case. So starting with the economy, I know that the stock market is not a great economic indicator, right? The economy reacts to things such as, monetary policy and fiscal policy, certainly geopolitics. So all those things that move the gold price also move the economy. The economy, however, also is based upon what our dollar is doing, what policies are coming out in regards to things such as tariffs, and trade channels and what have you. But the S&P 500, the Dow, the NASDAQ, those indices can sometimes conveniently be manipulated to be an indication of the economy. Sometimes they can be an accurate indication, right? So economic indicators don't just have to be focused on labor markets and GDP and things like that, but it can be the stock market, it can be the gold price, it can be the US dollar index strength. So we're going to get into all of that without trying to overwhelm you. And so any questions, you can put them in the chat. And Eric will be monitoring those. But the S&P, if we're going to take it as an economic indicator, I would say in this instance, it's somewhat of an accurate economic indicator, down 7.3% in 2025. The Dow down 3.7% so far this year. The NASDAQ is the big loser. All right, down. These are all numbers as of just 10 minutes ago, down 13.4% in 2025. But year over year, like over the last 12 months, you think, wow, I've lost a bunch here today. Well, sort of, yes, but you're still up 3.8% year over year in the NASDAQ, which is the big loser. That's the tech heavy stock that those Mag 7 stocks have really helped float. But Keith McCullough from Hedgeye the other day, he started calling them the Bag 7 because a lot of those stocks are already in bear market territory. So what's a bear market? A bear market is when we have something that drops 20% or more. That's technically a bear market. None of the stock market indices are in bear market territory yet. I say yet because I do think we're headed that direction, and not because of tariffs, but because it was coming anyway. here's a critical three more views of the stock market indices. This is the S&P 500. The reason I have this one up is you see these three lines. These are downturns in the moving average, right? The green one, the sharp downturn, is the 20-day, right? And I just showed you that we're down on the year, so it should have turned down. The red is the 50-day moving average, but the big, long, slow moving, the blue is the 50-day. The red one is the 200-day moving average. Okay. And nothing good happens, as Bill King likes to say, below the 200-day moving average, kind of like your parents used to say after midnight. Nothing good happens after midnight. Well, nothing good happens below the 200-day moving average. And here's the S&P 500 just far below the 200-day moving average. And really what I expect here is we've seen this downturn. You tend to get these little bounces. The market gets oversold. You get buyers coming back in, and then you start to see a resumption of the decline when you're in a bear market trend. And I do think that technically this will play out to be a bear market. And so this is going to come down to where we're down more than 20%. No exception to the rule. Here's the Dow Jones Industrial Average, again, below the below the 200-day moving average. The Dow Industrials have done the best of all of the indices because of President Trump's focus on industrials, right? And the industrialization of the United States again. And so there's going to be more optimism there than there is in some of the overbought, over speculated markets that the NASDAQ has in some of the tech sector stocks. And then here is the NASDAQ. This is the big one. Sorry. So here you see just far below the 200-day moving average. So not good news, but not a surprise either because stocks have been massively overvalued. This is the Buffett indicator. When stocks have gotten to an all-time high of 200% to GDP, you know it's grossly exaggerated in its value. It's necessary to have a correction, and you'll see some of these corrections, like sharp correction. This is the financial crisis and what have you. But it does generally climb over time, but this is too high of a valuation, and stocks need to correct. And again, it was baked into this cake long before the tariff conversation even started. The tariff conversation is significant though, right? So now there's an expectation that the tariffs could average, this is a US average tariff rate. This is before Liberation Day announcements yesterday, right? Where the expectation was that our average tariff rate is going to go to the highest point really since probably 1946. Okay, not quite as high as Smoot-Hawley, but now the expectation is it's going to be about 22%. So now we are talking about being in this territory of the Smoot-Hawley Act, which actually was very suppressive to economic activity, and it did drive us into a depression. In some arguments, in some circles, that's the argument that gets made. So here you see this volatility. This is the S&P 500 index. This is a lot of noise on this chart, but here's where we see the Trump win, and the markets had this exuberance. The markets rallied. The S&P 500 climbed, had a little bit of a pullback, and then climbed further into December, and that's when he started talking about a more aggressive tariff approach. And the markets didn't like it. From here to here, you see this just unknown uncertainty chop going on. And what's happening is there's new rules of engagement, right? There's new rules being made, and some companies will react accordingly. Some stocks will respond accordingly. Some won't adjust to the new rules and will get swallowed up playing a different game. But here's really where the trade war begins here. And then the market peaked, right? About a month after the tariff headlines really kicked in hard. Now, this is again before this morning, right? So it's even lower. But look at this: the S&P since that peak is down now about $5 trillion. So that can actually be a healthy thing because you're pulling money out. Like we've seen money supply peak, which I'll get into in a little bit. But the fewer dollars there are in circulation, you can create money out of thin air through stock values, right? And so this is a contraction of money supply in some instances as well. And it does have a disinflationary effect where people start to tighten belts. There's more competition in purchases. And so it does offset some inflation. But think about that. Between that and Bitcoin, just those two markets are down about $6.5 trillion in a very short period of time. So here again, we see an economic policy uncertainty index. All right. these spikes obviously happen in major either geopolitical or economic concerning times. So you've got the financial crisis here in 2008. Here you've got 9/11. The Iraq War begins. These spikes here. The COVID-19, obviously, with the shutdown and Brexit, we're now at the highest uncertainty level ever. Now keep in mind there's some bias to this because this is the Baker Bloom and Davis news-based index, okay, of economic policy uncertainty, and it's based on newspaper references to policy uncertainty. So they're taking New York Times and Wall Street Journal and San Francisco Chronicle and some newspapers and talking about that. Well, I think everybody would say that this morning this would be an accurate representation of how America feels with some economic uncertainty. And to me, it's why gold initially dropped this morning, but reversed right back up, because the best hedge for economic uncertainty is the gold that you own. Okay. Coinciding with that is the University of Michigan consumer confidence and inflation expectations. So they look and they poll people for their confidence in the economy, and then also what their expectations are for inflation. Okay, now again, there's some bias in this. It leans very heavily Democratic in the polling, and so you do get some bias in terms of the outlook, because you get some news source differences, as we all can relate to, and the messaging changes that from one channel to another. But anyway, this is a really fascinating image here today, because here you see the expectations for inflation spiking in this University of Michigan poll, and yet the expectations for economic growth shrinking, right? So you've got this disparity. They've crossed and they're going in severe opposite directions. And again, this is taking the pulse of the average, well, almost average American consumer. All right, here's PCE. So now this is something that I think is important for everybody to see, because this is Trump's first term. So as we get into some of the concerns about what is going to happen with the tariffs can drive prices higher. With a laser focus and clear messaging, you can keep it isolated to certain sectors, and that's really what they're trying to do. It's not supposed to be an across the board price hike. Okay, so inflation results more from increased money supply than it does tariffs or taxes on products. Okay, that's an example of price hikes, but not necessarily true inflation. The last time he was president and started hiking tariffs, he had 9 tariff impacted categories. And you'll see this dark blue line. Yes, the prices did climb. Okay, you'll see here about 4 to 5%. You saw an increase. But in all other core goods across the board, prices declined. Okay, so it really has to do with what's the money supply doing and what's the real health of the economy doing. What are wages and jobs looking like? And what are the rest of the assets and their performance looking like? All right, so what are current economic indicators? It's not all good, right? There is some negative news, and again, most of this, if not all of it, was absorbed by this new administration. So the equity markets are in a bearish trend. We talked about that. Manufacturing had been very poor. It picked up after the first of the year, and some of that was optimism. And since then, it's cooled. It was 50.9 in January, and it's dropped a point to 49. So there is a decline in actual manufacturing numbers here just as of late, and we'll see what a trend makes. Services had been doing very well. We had become a service economy. I heard it even on CNN. I was bouncing through channels here this morning, just hearing what people are saying. And on CNN, they were saying what a great service economy that we had. And that's exactly what this administration is trying to come against, is make it more of an industrial economy again, to where things are healthy from the bottom up rather than the top down. So employment has dropped here as of late. New orders have dropped. So new orders is an indication of economic activity, and that's dropped from 55 to 45 from January through March. So that's a negative trend. The Bureau of Labor Statistics reported that U.S. import prices increased last month. Now, they expected it to go down 0.1%, and instead the import prices climbed 0.4. So that's a half a point swing that was unexpected. That roiled the markets a little bit here last week. Oil should be trending upward now, which it is. We've put in our 3rd straight week of a higher price. The downside of that is we've all gotten, comfortable with the trend and the decline in gas prices. So I know this administration wants that to happen again. So, you know, keep your eyes on oil. But with uncertainty, you see the oil prices do similar to gold. Demand and production has retreated. The Atlanta Fed GDP now numbers are negative. So the Atlanta Fed does this kind of live tracking of what they expect GDP to be doing, and they're calling for GDP contraction. Which honestly is probably going to be the reality. It's much better than the negative 2.8% when you take into account gold. We'll get into this later in the webinar, but gold imports skewed because of the gold value and the sheer magnitude of gold coming into the country. You ended up seeing this spike in that imbalance. And so it's really, if you take out gold imports, it still would be negative 0.5% for the first quarter. The National Association of Credit Management is down from 65 to 55 in 1 month. So that, you know, as people go to borrow, which is not, again, a lending type of economy. That's the other thing, CNN. We had a service economy and we had a borrow and spend economy that was doing very well. And that's exactly the problem. So as you wash some of this out, there's going to be discomfort and pain. But this is the second biggest drop in the survey history, you know, second only to the financial crisis in 2008, where the credit management and coincidingly, you're seeing defaults in credit card balances as well as mortgages ramp up here again long before today. That's been a trend for many months. And then in risky fashion, 29% of U.S. household financial assets are in stocks right now. That is way too much and here's an image of that all-time high, the most that households have ever been invested in the stock market in terms of the percentage of their investable assets. And so, yes, it's going to be a scary thing here if we go into bear market territory. This is wage growth. So here you see this is an aggregate salary and wage income year over year. You'll see that the wage growth is slowed. It's still increasing, right? But it is definitely slower than it had been. So if prices do climb and wages don't keep up, that's pain for Main Street, and that's something that the administration will have to come against. It's shrinking less in the government sector. It's shrinking more in the private sector, and that's where you get that cumulative effect. Copper has been climbing, and that's an indication that usually copper is leading the charge in terms of expected economic activity. So if it's a barometer or a predictor of sorts, it actually is in a climbing channel and hitting all-time highs, and we'll see what happens with copper. I haven't even looked at copper here this morning. Counter to the narrative that you hear, egg prices have been dropping, gas prices have declined, manufacturing did pick up, although it's stalled here in the last couple of weeks. There's been over $1.2 trillion injected into the U.S. development and manufacturing sectors by foreign countries and domestic countries that say they're moving that type of production back into the United States. The Dow is doing best, as I mentioned, because of Trump's emphases. Focus is on Main Street, not Wall Street. So you're going to get just a lot of wailing and gnashing of teeth from the Wall Street hawks and people that you're seeing on the business channels, because this isn't about making Wall Street richer again. This is about stabilizing Main Street and changing the viable direction of the country and its economy. And keep in mind, you are the economy. That's the outlook now. And because of that, you have to manage your portfolio in a way that gives you that little microeconomic focus. And we'll get into the fiscal here in a little bit. And I talked about the bias in the polls, like with the University of Michigan sentiment. The sentiment amongst Republicans is that 0.1% inflation increase is expected, whereas Democrats foresee a 6.5% inflation spike. So again, with a grain of salt, take some of this news, because there's definitely propaganda and bias in the news flying around. All right, what is the fiscal update? Fiscal is our budget, right? Our fiscal situation is our income versus our expenses, okay, and what's going on from a government standpoint. So I took a picture of the U.S. national debt clock, where, as everybody knows, we're coming up on $37 trillion and counting. that is, unfortunately, every one of you watching owes at least $107,000. If you're a taxpayer, it's triple that to $323,000. And that is what is on your shoulders. And that shows the unsustainability of the path that we are on. And the budget deficit now is officially over $2 trillion. And another negative number here is that for the second time, U.S. federal spending has gone north of $7 trillion again. So this has to get reined in. What is helping is the the now $267 billion for this fiscal year that DOGE has claimed to have saved from a national debt standpoint. So we're saving about $2,300, and that's just getting started, and we need that to continue. And one of the most negative numbers on here is the 122.6% debt to GDP. So far more debt than what we bring in terms of a GDP number, which is about 29 trillion right now in terms of government revenues on the year. Marry that to the entitlements, right? So our expenses. So you've got Medicare, Medicaid is by far the largest expense. They have found some waste, fraud, and abuse in the Medicare, Medicaid sector, especially as it was going to millions of immigrants here that they automatically put on that to the tune of about $14,000 a year or more. And so some of that will get washed out, but you see what a huge burden that is, Medicare, Medicaid, and then the other entitlement, Social Security, at 1.5 trillion a year. That dwarfs, each of those dwarf our defense spending, which is now under 900 billion. But the biggest issue on this screen is the interest on our debt is now over $1 trillion. That means that we are spending more than $1 trillion a year just on the interest on our 37 trillion in debt. Okay, so that is the biggest red flag. And unfortunately, you have 9.2 trillion of our debt rolling over between now and June. And that means that you're going to add about 1% to that debt as it gets restructured. We've got north of $24 million in the next 3 years that's going to have to be rolled over. And so we really do need interest rates to come down. The Federal Reserve came out this morning and said that they, had planned on 2 rate cuts in 2025, as they announced 2 weeks ago. Now this morning they say they don't foresee any rate cuts. That is a political statement and is an anti-Trump position, in my opinion. But all that being said, I would not bank on rates coming down. Current dynamics in the fiscal picture, all right, and concerns. U.S. debt ceiling is now proposed to be raised. So the debt ceiling is going to be met and was kicked down the road until June in one of their temporary agreements. But the Congressional Budget Office estimates that if this House of Representatives package that they've put to the Senate, proposing to raise the debt ceiling by $4 trillion passes, it's actually going to increase our national debt to 62 trillion by 2035. So what I'm saying is, don't expect the debt to go south. I don't foresee, despite the tightening of the belt and finding of waste, fraud, and abuse, that there's any way in the short term that we can reduce the national debt. Can we slow its growth? Can we hopefully stall it? That, I think, is far more realistic. But you can't already, right here, you can't meet interest payments and entitlements already. So between those entitlements and the interest payments, there's no way to balance the budget, even if you cut the defense spending entirely and laid off all federal workers. And so we're already at 108%. With just the entitlements and the interest payments. What we're witnessing is a destruction of the left's monetary flow and funding, so the influence. And it's not, I shouldn't just even say the left there. That's not to be political. It's why you're hearing so much aggressive response from the left right now. But what's really happening is it is the draining of the swamp, right? It's impacting the money flow of the bureaucracies and the NGOs. And so, of course, you're going to have just a major media campaign against DOGE, right? And then, obviously, they don't want the inflows from the tariffs to be a positive effect if the president is successful in reducing the taxes and turning those into a permanent situation. The banking system remains very brittle. to me. They've lost a lot of deposits due to treasury yields and ways of getting a return on investment on just a cash position. And we really have to rein and streamline the efficiencies, because the path that we were on was perfectly designed path of the Cloward pivot strategy. And, unfortunately, reality and I think that we've sort of derailed that, at least for the time being. Here's the spending I talked about. We're back up over 7 trillion. I want to some quotes that Scott Bessent, our U.S. Treasury Secretary, lately, because it really tells you what this is doing. First of all, he spoke of monetizing government assets to reduce debt, right? So that's where the conversation, are they gonna revalue, which is, are they gonna sell the gold off the debt with it? I'll get into that later. The answer, no, in my opinion, but revaluing it certainly could make a lot of sense. What sort of a dent it puts into it. But the biggest news in that regard is that for the first time in 40 plus years, the government's talking about gold. That's huge, right? And it's part of why you've seen this massive influx out of Europe and into the United States, into the COMEX. They lent a lot of credence just by talking about it. They preferred to ignore it and try to negate its significance. Now central banks that have been buying around the world are realizing, oh man, the United States is coming to life on the gold scene, and it's rocking the physical markets. Here's a quote from Bessent. The economy has become hooked. We've become addicted to this government spending, and there's going to be a detox period. Well, that's what we're feeling right now. Okay, this is part of the detox period. Another quote, what I can guarantee is we would have had a financial crisis. So we were on a path to a financial crisis just because of what had transpired over the last 12 years, especially the last 4. And what he says here, a third quote, we are resetting and we are putting things on a sustainable path. Now, what he really wants to do is change GDP numbers, and it's going to slow down at first, but it's the debt that's the issue, and you don't want GDP stimulation by government spending and increasing the debt. We don't want to be borrowing to stimulate the economy. We don't want to borrow to hire, right? We want it happening because of the economy and reducing government spending. So that's what they're talking about doing here. And this statement here from Morgan Lewis, our analyst, if detox is necessary, it's only because of the magnitude of the intox over the past number of decades. Because every time we've been on the verge of a collapse or a crisis, they've printed their way out of it. The answer has been more money, more money, more money, and that's helped the 0.1% and the 1% and the 0.01% get incredibly wealthy, but it has not helped improve the standard of living of the average consumer, which is why you've had to buy gold. The government wasn't going to put you on the gold standard. You needed to put yourself on the gold standard. And what it has done is it's made you immune to those machinations. I heard a quote at a conference I was at in Newport Beach a few weeks ago, talking about the Trump administration and their tactics. And he said, ultimate uncertainty equals ultimate leverage. And so keep that in mind as you hear the news, because the more uncertain things can be, right, the better that is for gold, the more concerning it can be, but it provides far more leverage. He's got the entire world on its heels. They don't know what's coming next, and that actually provides leverage. And that's not just economically and trade. I mean, it's geopolitically and socially as well. All right, so there are recession concerns. I would argue that we're already in a recession. I've been saying that. It was coated over and painted over with government spending and hiring, but government spending cuts could cause or deepen a recession, right? And if that happens, that's going to reduce tax receipts. It's going to blow out the deficits to GDP even further in the short term. So you can see maybe like a curve coming down before we get back up into better territory. But it could undermine the U.S. financial assets. And I think this morning's stock market reaction and U.S. dollar index decline is a good example of that. Job cuts can reduce consumer spending. So the more jobs that get cut, the less spending there is, the less discretionary spending there is. That can increase debt and borrowing, which leads to increased defaults and a spike in bankruptcies. Business spending will be tightening. They're uncertain. They don't know what's going to be happening with the cost of goods sold or the materials that they need to be producing and manufacturing. Vacations intended, that's a term, vacations intended on a survey have crashed to the lowest level since 1978. Now, again, this is as of a couple weeks ago. So other than the financial crisis and COVID lockdowns, the vacations intended metric is at its lowest level since 1978, meaning people aren't intending on having or foreseeing having a lot of discretionary spending opportunity and traveling around the world. The economic slowdown, the concern is that it may cost the U.S. more than the extra income from tariffs. So they're hoping to generate about $600 billion in revenue from tariffs. You could certainly offset that with economic slowdown that leads to decreased government revenues. Slowing growth with climbing prices, that is stagflation, that's recession, that's where we've been for a number of years. Certainly it could get worse in the short term. And then the expectations index, again, kind of that optimism, if you will, dropped 9.6% to 65.2, and that's at the lowest in 12 years. All right, that's not a super exciting fiscal outlook and picture. Let's look at the monetary update here. So the US dollar index, this was not updated as of this morning. If it was, we'd be sitting right down here. So the US dollar index just had a major drop. As I look at the live value right now, 102.08, it was in the 101 area. But you know, this chart shows 104. If I zoom in on that, you'll see that we've had this sharp decline here just from the first of the year. So when Trump got elected and going into the election, when the expectation that he was going to win, the US dollar started to really rally. And remember, that's when gold had peaked at the previous high. So gold and the dollar have an almost perfectly inverse relationship where when the dollar is up, gold's down and vice versa. Well, post-election, you saw it or pre-election, you saw it running up, and then the reality set in. He won. Post-election, the dollar really rallied and continued its rally to about 110, and that's opposite of what this administration wants, right? They would prefer a weaker dollar because it improves your export opportunity and what have you, but unfortunately, it decreases your purchasing power as well. Well, since then, the dollar has weakened, and they've been successful in bringing that down. And again, this morning we were all the way down here. So a very precipitous one-day drop on the dollar index. More importantly than the dollar index is the money supply. So I talked about this is a chart that represents the problem with the cost of living in America. You want to know why inflation happens? Because the Federal Reserve prints money that the US Treasury borrows, right? Because the Treasury doesn't have the money. So the Federal Reserve creates the money, and the Federal Reserve gives the money to the Treasury. The Treasury distributes the money into the system and through the banks. And so you increase the money supply. The more money there is in the game, the higher prices climb. It's no different than Monopoly, right? When everybody's starting a game of Monopoly, you can barely afford to buy a piece of property that you land on. You get deep into the game and somebody wants to buy that property from you, and it's going to go for 4, 5, 6x from what you bought it for because everybody has more money, right? The money becomes relative. And so that's what happens with the money supply. And you see this incredible ramp up in money supply. Now it did drop post-COVID during the Biden administration. Unfortunately, it was offset by an increase in velocity. So now this is what we've experienced the last few years and why we saw a major spike in inflation. And that's because of the velocity of money, the distribution of money, putting it into people's pockets on a post-COVID stimulus and what have you. It picked up the velocity of money. You can see we have a lot higher to go. We're in serious trouble if we go back to that money supply ramping up and the velocity picks up. That's when things will really get expensive. All right, central bank balance sheet has to do with that. So why are we so bullish on gold for the long term? Because this trend doesn't change, right? This one does. This one does not, right? So it's money supply, and the money supply is coming from the Federal Reserve. Here you see their balance sheet. It could come back down, and they are tightening. They tightened, meaning they start to shrink the Federal Reserve balance sheet. It got as high as $9 trillion as a result of post-COVID stimulus and injecting all this money, right? 3.6 trillion to 9 trillion, all that went into the economy, okay, and directly into the pockets of American citizens. and really globally. So anyway, what ends up happening is this is coinciding with inflation, economic stimulus, printing and spending our way out of a problem instead of just letting it wash out. But they came against Trump in the first administration, and I will claim that it is a political organization now, with 90% of it being made up of registered Democratic voters. But now we see this turn down here in the tightening of the balance sheet, and this is going to continue. They need to reduce their balance sheet, but if we have a crisis, you'll see this climb back up again, because I don't think that the methodology is going to change. What is not money is Bitcoin. It can be a money alternative. It is not a gold alternative. And I wanted to put this chart up here because Bitcoin's down 14% in 2025. Okay, far greater than the decline in the US dollar index. And coincidingly, with gold being up 19%, which we'll get into here so far in 2025. So in gold terms, Bitcoin's down almost 25%. If it was the new gold and Bitcoin was a modern form of gold and a better alternative to gold, then we would see it outperforming in this type of a market sector. Bitcoin's down again this morning. And if they were directly correlated to each other, this would be like a flat line chart. But instead, you see this thing looks like an EKG, where there is a non-correlation between Bitcoin and gold. They act completely differently in the same market environment. All right. And sometimes Bitcoin is far outperforming gold. It's a great speculative return on investment type of an investment or diversification, but it is not gold. Okay. And that's why I wanted to show you this chart. Is it's telling us that it is not a gold alternative. It may be a currency alternative, but it's not acting like that today. And I'm a Bitcoin investor. I'm just saying, don't confuse it for what it is. All right. Here's the most up to date for March. The PCE, so consumer expenditures here have ticked up. So as you start 2025, we were chopping up and down, and then we did see a spike. So the reality is that prices have started to tick back up here a little bit. And in the core PCE year over year, okay, so this is month over month. This is from the previous month, the year before, or the previous month, but this is from the year before here. And so just a slight little tick up, but shockingly, surprisingly, you've seen that we have been on a steady decline, which is not inflation shrinking. This is not deflation. This is inflation increasing still at a slower pace, or as of this little uptick, it's picking up its pace again here just a little bit. So that is the reality. What are the president's wishes? He wants a weaker US dollar. He wants lower interest rates. They can lower interest rates if the labor market, cooperates and picks up. Decrease government spending, obviously, increase defense spending by allies so that it reduces our burden on our own budget. That's on all three of these first four. That's check the box, right? Mission accomplished so far. Main Street middle class focus, lower taxes. We'll see what Congress is able to accomplish on that here in the coming 2 months. Increase government revenues. I don't see that happening in the short term. In fact, that's going to contract significantly as a result of the measures that they're taking. To drive U.S. manufacturing and production, we've already seen fruits of the labors in terms of the tariff conversations and promises from companies. Because here's the deal: you can raise tariffs on foreign countries, and guess what? They're going to adjust and adapt. They're either going to start manufacturing in the United States, okay, but they can't do without U.S. purchases. Okay, they are completely dependent. Most are completely dependent upon us buying their goods. So what's going to happen here is there's going to be a lot of sitting down at the bargaining table, right? And that some of this will be pulled back as a result of promises. Again, ultimate uncertainty equals ultimate leverage. This is leverage, and the reality is they're dependent upon us. We're not dependent upon them, but we have exported our inflation. We've bought cheap goods out of China and elsewhere over the years that have really kept the cost of living in the United States much lower than had we been paying for American goods, because there's been no American manufacturing, producing, and competition in that regard. So if we're able to drive all that up and become less dependent upon those other countries, great. If not, it's going to be a trade balance that's going to be a great revenue generator through the external revenue services, as they're calling it, getting revenue from external sources instead of internal sources, meaning you, the taxpayer. Cheaper oil and gas, so that's been happening, and as well as increased production, check. Decreased debt to GDP. So I talked about Bessent wanting to shrink this, the debt to GDP ratio from 7% to 3%. So they're already telling you that the debt to GDP ratio is going to go up 3% if they have their wishes, but it's going to be 4% less than the path that we've been currently on. And then peace through strength. All right, so summary, I'm going to skip over this for the sake of time. Current trends, this is something that Jeffrey Tucker said back in December. Current trends in monetary and economic policy suggest that the second wave will hit the U.S. hard next year, meaning 2025, which will make the political environment highly volatile for any incoming administration. That's what we're seeing. It was predicted. We talked about it for many months. And it's a tough thing to inherit, but we'll see what happens with it. This is a talk that I gave in December to a group and some predictions that I made about the president and that we're already starting to see play out. So number one, that this is for 2025, that a recession would be declared, that global conflicts will continue to be provoked, which we're seeing, that there'll be a globalist strategy against nationalism and austerity. Just look at the Marine Le Pen election stuff that happened in France the last couple of days. That's happened now 4 times just in 2025. District court judges and unelected bureaucrats blocking actions. Okay, that's before it even started. Now this is a daily event. Job losses will be blamed on him. Inflation will run hotter. A bearish stock market will occur. All of this was stuff that we could see coming down the pike, and it's already happened. So what's happened with the metals? It is the rock. Gold is the rock in the lighthouse. Thanks to Hedgeye for this image. And those of you who own it, congratulations, and hope that you have no regrets. Gold closing above 3,000 makes it the most valuable asset in the world, more than the next 10 combined. So including the Mag 7 stocks and silver, gold is worth more than all of them combined. I'm going to skip this for the sake of time, but it's the trend with the first Trump administration. Gold initially dropped and then it continued to climb. I don't think that the plunge protection team is in place, and I don't think this administration cares about manipulating or controlling the gold price. I think they've let it go, and I'm anxious to see where we go as a result. So here's the gold price this morning, 3,112. We got back up to 3,120. What a beautiful chart. Okay, this is about a 6-month chart. It's pretty incredible. This is just the start of the quarter. So gold's up 19. This was through March 31st. So this is just the quarterly chart. Gold finished up 19.4% for the quarter, up 27.3% last year. All right. So year over year from April 1st to April 1st, gold's up 40%, and it's up 97% in 5 years. So pretty darn good performance for a hedge. Here you see this morning's activity, though, so I wanted to put a more updated chart in. So we had hit that 3,160, and look, we plummeted $100 from that peak to low when everything opened this morning lower because of futures markets. And then it immediately reversed and recovered, came back up, and again, now we're back up around 3,120 or so. I'll tell you live prices we record. It's actually 3,107. All right, so here's the 50-day, 200-day moving averages on gold. So if we're 3,107, we're still way up here. We're still north of all the moving averages, resuming the bullish trend. What has silver done this quarter? It closed up 17.4%. So those of you who have been suffering through silver, you have not been suffering as of late, even though it hasn't gotten the headlines that gold has. It was up 21% last year, and it's up 36% year over year. So about 4% less than what gold is, but still incredibly 12-month performance. And it's dwarfed gold's performance in 5 years. It's up 144%. So that's why there's balance, and it leads to the ratio conversation. But here's silver this morning. It did fall off and has not recovered because it is not the same money metal that gold is. Okay. And so this is the silver chart right now as we record. We're at $32.14, but you see here this morning what happened on this precipitous drop. Where are we going to go? I feel very good because this morning, Miles put this chart together from Golden Rule Radio, and you'll see this in the program, but we've got this pop off of the 50% retracement Fibonacci from this high and this trend line, and we've bounced. And now again, here we are back up north of 32. And if we're at 32.14, we're still below the 382. So we're showing weakness, but this trend is holding and might make just an excellent opportunity to be adding the ounces because the gold silver ratio has also increased. Here you'll see we are on that silver drop. We're below the 20-day. We're actually below the 50-day moving average now at 32.11. So we're going to be sitting right here, but north of the 200-day moving average, which we got below just temporarily in December. Platinum was up 8.1% to start the year. It fell down this morning. Platinum had a drop of 1.86%, and so not a fun morning for platinum. Right now, palladium. So I'm going to skip that, but palladium is up 6% in the quarter, but palladium is down 4.38% this morning, as you'll see by this chart here. So platinum and palladium have been kind of in a foot race and see which one wants to be ahead of the other, but palladium is still not.
Sorry, stand by. We're getting a phone call coming in and it's changing microphones here. Hang on.
Okay, how's that? All right, thanks. Sorry, technical difficulties. Okay. Supply and demand pressures have kicked in with the metals. Just a little bit here in terms of the opposite, right? So great supply, low demand, and physical buying, and that has driven premiums down. What we did see this morning on the silver drop is that silver American Eagles went up 1%. So even though silver dropped 5.5%, Silver Eagle premium went up 1%. So Silver Eagles are about 4% cheaper today, not 5% cheaper. Okay, and that happens often in a declining market. We're talking about monetization. We've had a huge flow of physical metals coming into the United States to back ETFs and futures. We have a revaluation that we've been talking about, which I'll show you an image on here a little bit in terms of the Federal Reserve and the U.S. Treasury and where's the gold and can we revalue it to fair market value. That's the Fort Knox concerns, is do we actually have it? That's been a 2025 talking point along with continued central bank buying. That Bank of England outflow to the COMEX, it's gone directly to the U.S., but it's also gone to Switzerland because London has held a lot of bars in the form of 400 ounces, and the COMEX operates on kilos, so they've sent just a ton of 400-ounce bars to Switzerland for refining and conversion into kilo bars, which are only 32 ounces instead of 400 ounces. And so that's you've seen a lot of outflow in both channels out of England to the point where they've had somewhat of a liquidity concern now. The ratios we'll get into here a little bit. Fundamentals are very, very strong for gold, weaker for the white metals because they're so industrially sensitive, and that changes those ratios. The technical charts we'll get into here, and then the gold lease rates have spiked. So to lease gold for some funds and paper-based assets used to be about 1/4 of a point. Now it's like 3.25%, 3.5% to lease gold. So that tells you that the physical demand has ramped up and that supply is pinched. Geopolitics continue to put wind in the sails of gold, less so with silver. And then $3,100 gold is telling us of a hidden crisis. So geopolitically, I don't think we have to get into the details of this, but so far there is no peace. There's been actually frustration with Ukraine and Russia in terms of them honoring ceasefires and not taking pot shots and some of the things that they're doing in terms of dealing with Europe directly. China just went through war games, yesterday off the coast of Taiwan. So things are ramping up, including with the U.S. and Iran. All that being said, here's a great image that answers the question, is my gold overvalued? Should I be selling here? All right. And hopefully we get into this in the Q&A. But the answer to that is no. Like the Dow to gold ratio tells us when gold is overvalued or stocks are undervalued. So if you were to sell gold and move into equities, today's a good day to look and be like, wow, there's some good value in the stock market. The problem is you just don't know how low it's going to go. Um, all that being said, you've got these lows in the Dow gold ratio when the markets have bottomed, most recently with the financial crisis and then with COVID, okay, bottoming at 12 to 1. And then what happens again, we print our way out of it. Well, we're at 13, the low 13s to 1. And so until we're in the single digits, gold is not going to be undervalued. And if it goes from 13 to 7, you will have missed almost half of that move where gold would literally do twice as well as the stock market. So hang in there. I'll skip that one. Here we have the gold to silver ratio. So this morning we just hit 97 to 1. That's a cycle high. And to zoom out here a little bit, it's the third highest we've ever had. So you'll see here that it being at 97 to 1, what this means is buy silver. This screams buy silver, because you only need a 20-25% drop where we would sell it and buy gold, and you'd still be well north of the average, which is about 63 to 1 in more recent history over the last 40 years. Okay, so the ratio is telling us to add to silver ounces here, and it's gold at a 20% discount. For the sake of time, sorry, I put together too many slides here. But I do want you to see ETF demand in North America up huge. Okay, so this finally started happening in February. The Western buyer was not the gold buyer, it was the Eastern buyer. Now it's moving into the West and ETFs are ramping up. And we've attracted 12 billion in 2 months into gold funds here finally coming to life in the West. So how much gold does the US have in reserves? I know this is going to get to one of the questions. So we claim as the U.S. Treasury to have 8,133 metric tons, and you're like, I don't know what that means. 1 metric ton is 35,274 ounces. Okay, that means the U.S. has around 287 million ounces if they have all of that gold. If 1 ounce is valued at 3,100, which is kind of where we are right now, that's about $886 billion worth of gold. It doesn't make our interest payments for 1 year. We have 37 trillion in debt. It doesn't put a dent in it. It does put a dent in it, but then it's gone, right? So one of the theories is do they revalue it at a higher, like if they go on some form of gold standard, do they value it based on that M2 money supply? Like if we have $22 trillion in circulation and we have 287,000 ounces, can we revalue it at that? And now that's where you're hearing that number where gold could go to $100,000 an ounce and what have you. Look, we focus on the reality, and the reality is the trend in gold is not changing anytime soon. In our lifetime, it's gone from 35 to now 3,135. And that's not going to change as long as monetary and fiscal policy remain on this course. And that's why we own it. We're not owning it because we're hoping to speculate like Bitcoin and that gold goes to $50,000 an ounce. So what do we do right now, right? It's time for you to reach out to us on an individual basis and let's walk through your investment triangle, okay? This is a way to approach the triangle or the portfolio in general. And every portfolio has 3 aspects to it. Okay, you have a growth and income aspect. That's going to be your stocks, bonds, mutual funds, annuities, and investment real estate. You have a savings component, right? That can be money in the bank, but it can be CDs or money market accounts or treasuries, something where you're getting a low yield on that cash position. And it's also your liquidity. And then finally, you have your physical commodity, your tangible asset. Doesn't have to be gold, silver, platinum, and palladium, but they're the most easily acquired and liquidated. We've been seeing a lot of liquidations just because of liquidity needs, not because of profit taking, but because there's nowhere else to turn for a liquidity crunch. And so your metals are very liquid. And what you find is that 2/3 of this triangle are doing well, while 1/3 tends to be weak. Well, this morning, this growth in income is getting crushed. Certainly the white metals have gotten hit, but your gold is staying strong. Okay, and you're steady in a percent return with treasury yields on your cash. When 2008 hit, you saw everything get hit at the same time, with the exception of the US dollar. When people have a broad-based panic selling, the only thing that rallies is the US dollar. That's not this morning. The dollar got a black eye this morning because of concerns for our policies. Okay. When you go to buy or sell, I want you to have this image on the recording because I want you to see what we operate off of in the wholesale market. So if you do need to sell, there's a bid and an ask in any given product. So in gold bullion, we don't set any of this, okay? But what we can talk about is what's the premiums, and that's the percentage over spot that something costs in the wholesale market, okay? And that's on the ask, and then the ask by bid is the spread. So we'll always talk about what something costs in the market before our brokerage fee, and then what we can sell into the market before our brokerage fee on the bid. And every product has a different bid that we don't set. And it's really dynamic in silver. If you look at the American Eagles, they're 10.4%. Yesterday, they were 9.4%. So that's how I know the premium went up 1% in the Eagles. The lowest silver is the 90% silver bags at 1% over spot. So there are ways to do it strategically. We talk about premiums, and I will steer you to another site called bullionvalues.org, and we can talk about this in the Q&A as well. But I wanted you to go to bullionvalues.org, and you'll get a sense for bid and ask prices so that we have full transparency and you have understanding on what it is that we're talking about. So I'm going to end that here. Here's contact information. And then Eric, I'll let you kind of fire off with some questions and we'll discuss.
Right on. Man, I hope you all got that, because that was a lot. Anyways, let me jump into some questions. First one, this was back on slide 16, and it was, I think, in reference to bullet point 2. You were talking about, and the question is, what was impacted? So if you go to slide 16, there you are, bullet point 2, manufacturing had been poor. Picked up, but now cooling again in January to 49 today. And I think you said something about manufacturing was impacted. And the question was, what about that was impacted, or what was impacted there on the manufacturing side?
Yeah, so it didn't get market specific. It didn't get sector specific, but there's a general manufacturing index. Okay. And so what happened is it had been declining. And then in end of December and then into January, it had peaked. And so they were starting to see, look, economic activity should be looking better because manufacturing in the United States is actually having a little pop here, but it didn't last. So between January and March, it dropped a point. So the manufacturing started to slow again. That I don't know what trend is going to materialize there, but the fact that he hasn't been successful in seeing a 3-month trend in terms of manufacturing activity picking up in the United States. That was my
Gotcha.
Okay.
I hope that answered the question. If there's more to that, fire away again. But next question, what are some options besides gold to protect cash if banks are not stable?
If banks are not stable and protecting cash, it's other hard assets, right? If it's not gold, it really comes down to almost kind of a commodity cycle. You can own coils of copper or barrels of oil or mineral rights or some of those things that aren't necessarily representative of paper. What they do on the wealth management side is deal with companies that deal with hard assets, right? And so that to me is the most important thing to look at. Real estate can be good. I do think that we're in for a softening in the real estate market. All that being said, it's also can become very illiquid. So you have to balance, am I looking for asset preservation at the expense of liquidity, or do I want both? The reason that gold is so ideal is that it's asset preservation and it's liquidity. Okay. And there's nothing that competes with it in that regard. You can, outside of the bank, you can get returns. Again, treasury yields are the safest money that there are. Talking to somebody on the paper side, that's the safest paper that there is in the world. Still, even though we all know that it's a house of cards, there's not another government treasury or bond that you want to buy right now. And you're getting north of 3% return. So if inflation is 5%, real inflation, even though they state 2.8, but you're getting 3%, at least you're maintaining liquidity and some purchasing power, preservation.
So next question, what was the Bullion website again, and what are the best ways to buy junk silver? That Bullion website, Tori will put that up, but it was bullionvalues.org, bullionvalues.org. That helps give you a up-to-date and historic pricing on there. And the best ways to buy junk silver. Tori, take that one.
You bet. So here's the bullion values, just so we got that up here. Best ways to buy junk silver are when the premium is low. And today is a double opportunity because the second best way is when the price is dropped. So when we get down to those technical support levels, so anytime the chart, the trend is down, we're looking for support levels like a floor and try to predictively tell you and educate you where is the next floor, because instead of buying at the ceiling, you can buy at the floor. And then with junk silver, it's all about the premium, right? And so if we look at an image of junk silver premiums, you'll see that it spikes because it's a finite universe of product. We don't want to buy when the premium is high. Okay, we want to buy when the premium is low, and like I showed, the premium is incredibly low. So I'm going to show you an image on the junk silver premium history. And you'll see that here, and you see these spikes, okay, where it's gotten as high as 60% over spot, and that's not where we want to be buying, okay? You want to be buying when the junk silver is down low below this 5% trend line, and I showed it to you. It's 1%. Okay, so we're basically at the floor. So this is an opportunistic buying time. These are selling times, right? Where we come out of the junk silver on these spikes in order to pick up free ounces. We'll move from junk silver into bullion bars, whose premiums are below that 5% line. And you make up this whole difference. You pick up 15, 20% more ounces of silver for free just by riding that spike. So it's not like you can't buy silver all the time, but to your question, which is a great question, there's more opportunistic times as to when we'd be doing that.
Mm-hmm. Yeah, good question. So really quickly, we're at the top of the hour. I know some of you may have just carved an hour. So if you need to go, thank you. We will continue to record this. You will be sent a link to watch the recording, and you may be able to scrub kind of towards the end to the Q&A time. So if you do need to go, thank you, thank you, thank you. We want to be respectful of that too. But there are a couple more questions, so I'm going to keep going.
Okay.
And email or call, like Tori mentioned as well. Recommendations, explanations between physical versus ETF metals investing.
ETF metals investing is great for the short term. So if you're looking for a short-term hedge, if yesterday you were getting concerned that the stock market was going to have a sharp down day and you wanted to add to your like sell some stock and move into gold, it would have been opportunistic to do that. You're not going to do that in the physical world for a short-term play because the spreads are too wide. Okay, so going back, like just looking at this image here, like the gold American Eagle, if the bid is 3,137 and the ask is 3,234, you're looking at a difference of what, about 4% or something. And then you have a brokerage fee on top of that. So I tell people, look, in the physical world, you've got to be looking at it as a 3+ year hold. Okay, because you've got to see about a 10% increase in the spot price in order for you to be back at a break even. Well, in the paper markets, that's not the case at all. With our vaulted program, you only need a 3.6% move, okay, at vaulted.com, which is also an app. You need a 3.6% move to be at a break even, okay, because we've pinched the margins in that because of the form of gold, the location of the gold, cutting out people like Eric Oshaki and myself. So anyway, vaulted is a great opportunity for you in that regard. So it's a happy median between ETFs and the physical because you own allocated ounces in vaulted. But to own the coin in hand, the coin of your choice, you've got to go this route, and that's not going to be a short-term play. You're gonna look also, if you're just trying to capture a 4, 5, 6% move in a short period of time, stick with paper by all means. Paper has the benefits of the tighter margins, the lower spreads, obviously, and lower costs. It doesn't provide the privacy. It doesn't provide the opportunity to take advantage of tax loss harvesting. It doesn't provide the off the radar nature of it, right? It doesn't provide the spendability, any of those types of things. So there's pros and cons to each category, and always happy to kind of walk through those.
Yeah. Yeah. And as Tori was mentioning, the vaulted program, this goes into the next question. Do you guys mentor the vault accounts? And this vaulted account, vaulted.com, check that out. You are assigned an advisor. We keep you all together. So Tori would be your advisor if you open up a vaulted account. And we do mentor on that. We can share market indications, market timing, trends, technicals. All this applies to your vaulted account, as well as your privately held, as well as your IRA if you're in that category as well. So yes, lean on us for all of those buckets as you're investing. That was the last question.
I have one more that came from a
Perfect.
client. How does pricing work? I hope we showed you that, but for transparency, like if you go to sell, let's get into the sell process just in case, right? Just like when you buy from us and we ship something to you or we ship it to depository, it's the opposite, right? When you're going to liquidate. So we may have you ship the product that you have in your possession to depository. We may have you ship it to us. We would give you the instructions for doing that. The product can't be liquidated until we're actually in possession of it. So the way that it transfers is you literally go to the post office like mailing any package, and you put it in registered mail, right? So registered mail comes with a receipt, comes with a tracking number, but it also comes with insurance. And so that package gets shipped insured. We'll tell you the value to state on the package, how to box it up, where to have it go. And then once it's received, whether in our depository account or here, then we'll at that point be able to sell if you want. You don't have to sell. You never are obligated to sell. We may just end up sending it back to you if you don't sell. That's how that works. And that works off of that bid price on the site that I showed you, minus the brokerage fee, okay, which default is going to be 4%. So it's going to be 4% below that bid price in a standard transaction. And that would be the net price paid to you. And then we pay, and that tends to be about a 2-week settlement, either through wire or check. And that check can go regular mail, it can go overnight. We don't charge a wire fee, but we pay directly into your account. So it's a very liquid investment. Vaulted is different. Vaulted has 24 to 48 hour settlements from you selling in Vaulted to the money being in your checking account that is linked to your Vaulted account. So lots of different avenues that we can talk about between storage accounts too. If you have a storage account, the liquidation happens immediately. You're not sending anything to us, whether it's in your IRA storage or whether it's in non-IRA storage.
Mm-hmm.
That we can treat like an equity and just sell it in the live market at that moment. And then you direct a metals movement. It's called, that's where our team would walk you through the logistics. Okay.
All right. That's
Good.
through all the questions I have. I think through Tori's. Oh, wait, one more. How should contributions be split? If you were sending in funds, what would your percentage breakdown allocations be here?
Right now, I'm very aggressive with a ratio of 97 to 1. I'd be saying 70% silver, 30% gold, maybe 60-40, but definitely heading on the heavy side with silver. And because again, that's going to represent 25% to me, a 25% discount on gold. So instead of buying gold at what 3,100, you're getting gold at roughly $2,400, technically, because we'll move that silver into gold later. And with an IRA, it works beautifully because, the contribution to the IRA, the money getting in there, all profits then are no longer tax. When we make that swap, you're not generating a taxable event in the account. So the gain to you is much cleaner because we don't have to take that into account. So heavier silver right now. But feel free. That depends on your age, your stage of retirement, right? And if you're 40 years old asking that question, it's going to be a different answer than if you're 80 years old and on a tight budget. But not that you're contributing to your IRA anymore, but hope that helps.
Awesome. A couple last, will a recording of this be available? Yes. So if you registered for this event, those of you who got a link, registered, I got all that information. A recording of this should be sent to you from Zoom with this recording. Once it's all finished and rendered, it'll come out to you that way. So look for that email. If for some reason you don't see it, check a junk folder or a spam folder, something like that. Reach out to us if you're still having trouble. We can always send that to you. What about between stock IRA to gold Roth?
Stock IRA to gold Roth. Okay, so if the stock IRA is a traditional, then what I would recommend is that you move the traditional over to a traditional precious metals IRA. We buy the metals and then we convert it to a Roth, because the premiums in the metals will reduce the size of the IRA on paper, and it will reduce the tax obligation on the Roth conversion. If you're talking about just moving from a stock Roth to a gold Roth, the order doesn't matter, right? You would liquidate the stocks, have it ready in cash. Eric is the guy that would walk you through an opening of an IRA account and the transfer of those funds from your stock IRA to your new precious metals Roth IRA. And then once those funds hit, then you and I are talking and we're having a conversation, and we're going to see where values are. We're going to see where premiums are, ratios, that sort of stuff. And we'll get you set up dynamically on the front end so that we can compound those ounces over time through the ratio trading or premium swapping. You know, like for example, Silver American Eagles have a premium play in IRA accounts, whereas Canadian Maple Leafs and Bullion Bars don't. Right. So we'll get strategic on what you buy in the IRA, but just know that Eric's got the whole logistics and process down on getting that account opened and funded.
Yep, that's right. All right, I think that was it. As always, email, call, reach out to us. Happy to have that triangle update conversation, help answer other questions. Once this recording comes out and you get the fire hose again of all 70 of Tori's slides, you may have more questions. So keep them coming to us and let us know how we can help. One more, can you talk about gold ETFs? I'm
We already
thinking
did.
that's what that was.
Yep, we covered that earlier in. So, but yeah, feel free to call me.
Mm-hmm.
Don't think that you guys don't have direct access to us. So that number that I put up, the 866-211-8972, that's going to ring right here to our office. Deanna or Eric or I are going to answer that. Deanna is working feverishly through this podcast and through this webinar. I mean, to be getting out quarterly statements. So those of you who are signed up to receive a quarterly update on the value of your portfolio, give her some time. You'll be seeing those hit your email this week. If you ever want one of those mailed, just let us know as well. But yeah, don't hesitate to reach out. You don't have to just tune into things such as this. Call, email anytime at your convenience. As always, we're so grateful for you.
Yes. Yes. Thank you. Thank you. Again, call or email. Let us know how we can help. I think that's it.
Keep your seatbelts on. Have peace, optimism, hope. All is well. You're a precious metals holder, hopefully already as well. If not, give us a shout. Take care. God
Thank
bless.
y'all. Bye-bye.